Thanks for joining us today. I'm Michael Lytle, Chief Investment Officer for StoneX Wealth Management. Today, we want to take a look back at last week's inflation reports and cover a few of the nuances that we see inside the data. So we'll cover CPI and PPI. If you're not familiar with those acronyms, CPI are consumer prices. That's what all of us pay at the store or somewhere where we're acquiring a service. PPI are the producer prices, the inputs, if you will. So there are some nuances between the two of these that we want to discuss before we get into the data itself. First, producer prices tend to be more volatile than consumer prices, and that's really for two primary reasons. One, producer prices are closer to the source, closer to the inputs. So even if we go to what's called the core version that excludes food and energy, things that are more volatile, the inputs themselves still are subject to changes in inventory, to maybe supply chain disruptions. And so there tends to be more variation in those producer prices. So that's one reason. The other reason is there's an intermediary for us, the consumers, between what's produced and what we pay. And that may be a retailer, that may be a service provider. These are people that are buying those goods and then re-providing them or reselling them to us. So they have a choice to make. They want to keep us as customers. And so often you will see them smooth out the highs and lows. So maybe when producer prices increase some, they don't raise prices quite as much. And then when they fall back off, they hang out there a little bit longer to kind of make up what they gave up. And then that helps to smooth it out for us, the consumers. That's the two main reasons that you really see a difference in the way they behave. But last week we saw consumer prices that came in, frankly, just kind of where they've been the past few months. A little higher, a little lower, no major trend, just kind of a flatlining. A little higher, I think, than everyone would like, but a flatlining, no discernible trend. The producer price report showed a large increase, a big surprise. And it begged the question for us, obviously there is a relationship, but what kind of relationship has the data shown over time? So if you look back over the last 5 years, in 2021 and 2022, producer prices started to rise and consumer prices followed about 6 to 8 months later. And so I wouldn't get too hung up in, is it month 6 or 7 or 8, but just realize there is a little bit of a lag and it kind of happens in that time frame. We also saw producer prices spike a lot higher than we saw and peak, if you will, the consumer prices. And that goes back to that point of the intermediary trying to cushion that while still maintaining a reasonable margin for their business. So the same thing on the way down. That producer prices rolled over and started to fall about, again, 6 to 8 months before we saw that show up in consumer prices. And so that really begs the question this time, are we going to see that same relationship? And for us, it comes down to two things. One is the magnitude. So how much higher do producer prices go? What is that gap that retailers and service providers are having to eat? So that's one. And then two, how long does it persist? We're always careful not to draw too big a conclusion from 1 month's worth of data. So do we see this persist? And then again, where does that peak out? Because that will tell us, at least in our opinion, how far up or at all consumer prices move to kind of make up that gap between the two. So those are our thoughts. We'll obviously share more as we see more data come in. Thanks for joining us today.